Hey guys, welcome back to our channel where we talk about all things real estate. In this video, we are continuing the series on real estate bookkeeping and the importance of this topic in your business. In volume 1 of this series, we discussed how you should start to think about the financial life of your new real estate business and how to begin setting up the accounting transactions for it. To recap, we established the main categories of accounts that should hold your transactions. These main business account categories are the assets, which is what the business owns, the income, which is the revenue that is coming into the business from its activities, the liabilities, which holds everything that the business owes to others, the expenses, which are what the business must spend to keep its activities going. And finally, the equity, which represents your interest in the business as an owner. We also pointed out that your business has a financial life of its own, which we denoted by this closed loop. Now, with the financial boundaries of the business so defined, we established rule number 1, which is that any financial transaction with or within your business would need to happen through one or more of these main account checkpoints. Now, in the beginning, your business has not made any real business transactions. So it is likely that whatever the business owns is just coming from your capital investment into the business. And we said that this happens through the equity checkpoint. And whatever investments you make into the business is being held as part of the assets of the business. These assets could be as simple as the bank account holding your initial capital contribution to your business, or it could be a real asset, such as the first rental house that you own or bought as part of the business. Now, except when you are starting with a lot of cash, your initial investment may not be enough to get you started in the actual business of real estate rentals. In many cases, you need additional money to buy a property in the form of a loan of some kind. And this loan can come into your business in the form of a mortgage through the liability checkpoint. Finally, the combination of a mortgage loan and your initial capital investment enables you to acquire a house that you are now ready to rent and start to make an income. Income is the money that is coming into your business from the main activity of the business. For example, in a real estate rental business, that would be rent. For an Amazon business, that would be the sales that you make on Amazon.com. Expenses, on the other hand, are the costs the business has to pay in order to do what it does. In a real estate rental business, for example, that would be things like some of the costs to repair your rental house, taxes, insurance, and the like. Now, the difference between your income and your expenses for the business are your profits. Now, you would notice that there is no clear bucket designated for profits. That is because anything of the business that you can claim as an owner is part of the equity checkpoint. Therefore, any profit that the business makes should go into the equity category. Having established the main bookkeeping buckets, it becomes immediately clear that there must be subcategories for each one. For example, in the income category, there are actually different types of income for the real estate business, with rent being one of the main ones. Now, you might of course have other related sources of income, such as late payment fees, or perhaps a coin-operated laundry. pet fees, and the like. These can all be different sources of income for your real estate business, and you can break them down as much or as little as you want. Go with what makes sense to you. Similarly, in your assets category, you might have the operating account to hold the operating cash of the business, an escrow account to hold the cash such as security deposit that you collect from your tenants and that you intend to give back when they leave the property. And you might also likely decide to hold the value of the houses that you purchase in a physical assets subcategory. Likewise, the expenses of the business come in different subcategories. Depending on the region you are in, I find that it's helpful to categorize your expenses in the same way as the tax authorities in your region do. In this way, the filing of your taxes would be very easy. In the US, for example, these categories would include expenses for advertising, auto and travel, cleaning and maintenance, insurance, management, legal and other fees, mortgage and other interest payments, repairs, supplies, taxes, utilities, and the like. Also, the liabilities that you undertake for the business come in different forms. Some of the main ones that we have already looked at include mortgages, security deposits, credit cards that you might be using to fund the operations of the business, and things like prepaid rent. Finally, the equity section we saw earlier, that you as the owner of the business can contribute capital to the business, especially in the beginning. This capital will be entered as an owner contribution subcategory in the equity section. Later on, as the business matures and becomes profitable, you can also withdraw profits from the business to enjoy your life. This will be entered in the owner withdrawal subcategory of the equity section. Now, being an ambitious business owner, you might also decide to defer gratification and leave your profits in the business to fund additional growth as part of the retained earnings section of the equity category. Remember that the breakdown of these subcategories can be as simple or as complex as you want it to be. For example, you might decide that for income, you only want to make a simple separation between rent and all other sources of income. And so, in your income subcategory, or in your income category, you only have rent as a subcategory and other income as another subcategory. This is good enough. We have by no means been exhaustive of the various subcategories, but tried instead to show you the structure of the whole thing. Now that said, I would strongly advise that you keep it simple and functional in the beginning. If you just use what we show here, you should be fine to get started. With these subcategories, you would have established all the pieces that are necessary to fully capture and describe the financial life of your business going forward. If this were a book, you would now have all the chapters and subchapters to tell the whole financial story of the life of your business. From here on out, you would be able to take a simple look at your accounts and have a very clear idea of how your business is doing. Not to talk of making filing your taxes a breeze. Of course, when many people think about accounting and bookkeeping for their business, real estate or otherwise, their focus is mainly on managing tax filing. But I think an even bigger reason for doing this is really to understand your business and how to drive its performance. We will discuss more about this topic and the concept of flows in the next video. Please let us know in the comments below if you find this type of content helpful. You would be encouraging us to create more content by subscribing to our channel and clicking on the notification button so that you will immediately know when we put out new content. Many thanks, and see you in the next video.